Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 68. On today's episode, we're going to be talking about when is good news bad news and when is bad news good news. The market has increasingly become data dependent, and so we're going to discuss what data is the market looking for and how can you help interpret it and how is it going to impact your portfolio. So get your mind right. Let's get to work.
You dropped this.
Well, welcome back to the program, everybody. If I have learned one thing over my years of investing and providing financial advice, it's that when times are bad, it can be a very lonely place. Nobody wants to discuss investments, finances every day. It's just worse and worse. The data gets bad. Nobody wants to discuss it. Everybody wants to pretend like it's not happening. And it can be a very lonely place. I get it. I mean, nobody enjoys losing money. And so my job is to walk into the fire and convince other people to do so as well. And so even though you might not want to discuss finances or investing, here we are. We continue to be consistent and we continue to move forward. So the topic of today's conversation is as confusing as it sounds. When is good news bad news and when is bad news good news? And so this comes to us because this past week, the market had a really strong Monday and Tuesday. Really bounced back. We were very, very oversold. And so you've heard me over the number of episodes. There is something called the S&P oscillator, which is a number that I subscribe to that shows you whether the market is overbought or oversold. And it does this based on the number of sells versus the number of buys in the S&P. And so a couple weeks ago, we hit minus 13 on that S&P oscillator. And it's only the second time I've ever seen that happen. And the last time was 2008, 2009. And so, which means the market is extremely oversold. We worked some of that oversoldness off on Monday, Tuesday. The market was up substantially both days. And then, of course, by the end of the week, it's like it never happened. And so on Friday, we had the jobs number come out, which was the number of jobs added in September. And the number was 263,000 jobs the U.S. economy added during the month of September, which was a little bit higher than what the expectation was. The expectation was around 250,000. In August, we had 315,000. So it has come down, but it's not enough. So this whole good news, bad news means that because the job market is still robust, that means that the expectation is that the Federal Reserve is going to have to continue to raise interest rates. And so the continuing of raising interest rates means that they are trying to slow down the economy, which means they need asset prices a la your stock portfolio, your 401k, your house. They need all of those things to come down. And so the market is constantly looking at this data to try to fortune tell whether the Federal Reserve is going to slow the pace of raising interest rates. And so when you get this good number, the jobs report being good, that means that the Federal Reserve is going to have to continue to raise interest rates for the foreseeable future. And so the market sells off. And so it shows you how ready the market is, though, for when the Federal Reserve does slow down interest rates, how much money there is on the sideline just waiting to flood the market. Now, I think it's going to get, I'm not going to say worse before it gets better, but this week is kind of an interesting week. So tomorrow is Columbus Day in the United States, and it's a bank holiday. and a bond market holiday, but it's not a stock market holiday. So this doesn't happen very often. So the trading action tomorrow could be a little wonky, if you will. But we do have some big numbers that are coming out this week. And so, it just continues. And so the data coming out over the next couple of weeks is going to really impact the market in a big way. And so this week we have the producer price index coming out. And we also have the consumer price index. So the producer price index comes out on Wednesday, and then the consumer price index comes out on Thursday. And that CPI, that consumer price index, that is the big inflation number that everybody is looking at. So that's going to be the one that tells you whether prices are starting to move back down or is inflation still high, and the market will 100% be moved based on what happens with that number. And so you have to realize that there's a little bit of a delay on that. There is no Federal Reserve meeting in October, so there will be no interest rate hikes during October, but the Fed does meet during November and December. So that's kind of what the market is keying off of. And so we'll see. We'll see if prices have moved down. Have they not? And then also Friday starts corporate earnings with a lot of the banks. So Friday you're going to have JP Morgan Chase, Citigroup, United Health, and there's a lot of companies that have come out and said, "Hey, the global economy isn't doing as well as we thought it would. Our earnings are coming down. They're moving their guidance. They're cutting it by 10, 15%. And so these are all things that have to happen before the market can make the turn, if you will, to start going back up. And so we've got to get through this bad data, this bad news before the market can turn. And so right now you also have the dollar is very strong. Many would say too strong. And so what that does is it makes, if you want to go on a European or a vacation to the UK, it makes it cheaper for you. But the problem is that there are a lot of companies that are multinational corporations where we have a lot of people outside of the United States that buy American-made products. Well, when the dollar is this strong, it makes it harder for them to be able to purchase those. It makes it more expensive for them, so less people buy, and it impacts the earnings of American companies. So that is also playing into this. So there really is not a lot of good news out there, but you have to realize that just like we've talked about in the past, you have to keep the consistency going with what you're looking to save. And if you haven't started saving or investing yet, today would be a perfect time, I would think. It's always the best time, right? Best time to plant a tree was 20 years ago. And so all of this data that we're looking at, and everybody's hanging on to every new reading that comes out every day, you know what? In 5 to 10 years, it's not going to matter, and you're not going to remember what was going on. And if I asked you what the CPI number was in 2013, you probably couldn't tell me, and I couldn't tell you what it is either. So the one thing I do know is that good companies continue to be able to innovate. They're able to make transitions better, and they will figure out a way to win. And so that's where my faith is as far as being able to put money in certain places. Now, the emotional side of this, the mental side of this, the taking the pain on a day in, day out basis is not something that everybody can do. It is not something that everybody can do. And so, you will get people who sell out. This year has been so painful. There are people that have sold out that'll probably never invest again. That's always an interesting piece of this that I look to when you look at studies. There's investors that sold out in 2000, 2007, 2019, 20 when COVID hit. Every time there's big market moves, there's people who leave the stock market forever. And so don't let that be you. Think of the companies that you want to be invested in over the next 3 to 5 years. If you buy something, if you invest in a company today, again, I know I've said this before. I'm going to keep saying it. I'm going to keep saying it. If you invest in a company today, you have to be willing to invest a little bit more if things get worse, right? So I kind of look at it when I invest in a company. If I invest in a firm and I want to make another investment, I want to make sure that it's about 5% in this kind of market. I want to make sure it's about 5% lower than where I'd made my last investment. And so sometimes you get there, sometimes you don't, but this is the kind of market where you want to be patient and you want to make sure that you don't make moves, rash decisions, because that's a good way to lose money, right? And we've talked about that over and over again about keeping your emotions in check. And so, all of these things, the bad numbers, they just keep getting worse. I'm sure some of these companies are going to report earnings and they're not going to be good. And they're going to say that the outlook isn't that great. And that's exactly what the Federal Reserve wants. So they want the economic conditions to soften. They want it to be weak. They want they want consumers to slow down their spending and investing, and they want inflation to come down. And as far as it looks, they're going to be keeping the hammer on that for as long as they have to until these numbers start to move down. So that CPI number on Thursday is going to be a big deal to see if inflation, in fact, is starting to soften a little bit. It looks like we could have peaked. I don't know. We'll see on that, but definitely we want there to be a lighter reading on that. One interesting article I saw. This is kind of moving away from this topic here. Let me see if I can find it. I don't know what I did with it, but there was an article in the New York Times this weekend that talked about one of the fastest growing areas for younger consumers borrowing money was on weddings. And I believe the name of the company is Carrots and Cakes. Let me check and see if that is correct. Yes, that is correct. So a company, Carrots and Cakes. Is it Carrots and Cake? Carrots and Cake. Geez, no S on the end. It's a company where allowing people to plan their wedding, do all this stuff. And I found it interesting because there's a growing trend in people financing their wedding, which, man, one of the number one reasons that for divorce in this country is because of financial pressure, right? It's one of the number one reasons that people get divorced. And so I'm just thinking to myself, wow, financing your wedding and then paying that off long term, what could possibly go wrong, right? So just one of those things that you have to be careful for. When we did the episode on buy now, pay later, it's one of the biggest areas that young people, I would say 30 and below, are getting in trouble with, is they're doing all this buy now, pay later stuff, and then they're not actually paying for it later. And so you just have to be careful. I mean, financing your wedding and getting started on that kind of foot could be just a potential disaster for people. So, and I think about that as the economy gets worse, and as maybe people start losing their jobs, and which is what the Federal Reserve wants. They want unemployment to go up. You just have to be very, very careful that you do not get into debt that you can't handle. So, with the Federal Reserve raising interest rates, we talk about how your savings rates and things like that have gone up, but you also have to be careful because your credit card rates are going to go up as well. So with interest rates rising, that means that the cost of debt is going to go up. So if you're going to buy a house, if you're going to buy a car, if you're going to charge things on your credit card, be careful because you probably don't realize it, but your credit card rate has probably already gone up this year. And, they send an email or whatever that says, terms and conditions have changed, and you hit delete and we don't really pay attention to it. But do yourself a favor, this week, if you have some credit cards, just make sure to go look and see what your rate actually is. And if you have a lot of money in a savings account somewhere, be it just a normal bank like Wells Fargo, Bank of America, somebody like that, they probably haven't gone up on the rate that they're giving you. Look for a high yield savings account like Ally or American Express, somebody like that. They're paying over 2% now on savings. But truly, There's things you can do like that to be a little bit more proactive, but be very, very careful that the credit cards that you're using haven't skyrocketed your rate. It's not that they can't do that, but you just need to be aware of it so that you don't get yourself into trouble when it comes to trying to pay for things in the future. So, as with all things financially related, you have to be proactive because nobody's going to pay attention to it more than you do. So make sure if you're making some investments, again, this data is going to remain hairy for a while. So if you invest in a company, be prepared to invest more. And then also be ready to trade around a position. So if we get a couple good days where it looks like the market is going to go up, like Monday, this past Monday, the Dow was up 700 on Monday and on Tuesday, be prepared to take a little bit of profit. So if you have 10 shares of a company and it goes up, 8% or whatever it was, 5% in 2 days, sell 2 shares. And then if it drops 5%, buy those 2 shares back. So many young investors or just inexperienced investors think that you got to sell all of it or buy all of it. You can trade around a position. So make sure that you are familiar with that. So as we sum this up today, not a long episode today, but just keep looking at the news. You're going to need the news to get bad before the stock market gets better. And I know that is completely counterintuitive, but we need some bad news in order for the market to bottom and for us to be able to start on that upward trajectory to having another good market. So I hope this helps. I hope it frames out the market for you a little bit. Appreciate you listening. I hope you have a great week, and I'll see you next time. Thanks, everybody.